If you're not careful, the newspapers will have you hating the people who are being oppressed and loving the people who are doing the oppressing.
Going back to the Reagan years, you think bond vigilantes are back?
Yeah. These are very large numbers. You've seen it a little bit. You had the crack in the bond market in COVID a little bit. The government did the right stuff, then they massively overdid both spending and QE. We borrowed and spent $10 trillion from 2020 to today. Okay, and you heard the numbers before. We also bought $4 trillion of your securities on top of the $4 trillion we bought in the first go round. Those numbers are true globally, not quite as big as ours, but the QE of us was $8 trillion. The QE of the rest of the world was another $8 trillion or something like that. You're talking about huge sums of money. We don't really know the full effect of that. And, the bond dealers, which Gary mentioned, inventories are much smaller than they used to be, partially because of rules and regulations. And you are going to see a crack in the bond market, okay? It is going to happen. And I tell this to my regulators, some of who are in this room, I'm telling you it's going to happen, and you're going to panic. I'm not going to panic. We'll be fine.
Jamie Dimon, the CEO of JP Morgan Chase, is making some bold predictions about the U.S. debt market. He's saying that there's cracks happening right now in the Treasury market, specifically in the long end of the yield curve, the U.S. 30-year yield as well as the U.S. 10-year yield. The U.S. 30-year yield is almost at 5% and is continuing to grind upwards. When U.S. debt sells off, the Treasury yields rise. There's an inverse relationship. The big, beautiful bill that just was passed was adding $4 trillion to the deficit, with $5 trillion needed to be added to the debt ceiling. As the government spends, the U.S. Treasury issues Treasury bonds into the markets. There are banks, foreign nations, consumers purchasing these treasuries, and the U.S. government is promising to pay them back at a different time. This is how the U.S. government raises funds.
Panic. We'll be fine. We'll probably make more money, and then some of my friends will tell me that we like crises because it's good for JP Morgan Chase. Not really. I tell people when Credit Suisse went bankrupt at the First Republic, it was terrible for the banking industry. I think we can make everything better, including that, by just changing and modifying certain rules and regulations, letting market makers intermediate more in the market. But to give you a number, like just JP Morgan alone buys and sells $3 trillion a day. And we move $10 trillion a day of money. And we're probably a tenth. So the money moving around the world is $100 trillion a day. The money moving around the investments, this is stocks, bonds, corporate governments, derivatives, credit, you name it, FX, sovereign debt around the world, 30 trillion. The people who set those long-term rates are those people, including you in the room. It's not the Federal Reserve. They can try to manipulate the long-term rate. They can do what's it called? They do the twist or whatever. It doesn't work for that long. So if you look at economic history, bad things happen. When those tectonic plates shift, it's very hard to see in real time. It is shifting, and this is one of them. I just don't know if it's going to be a crisis in 6 months or 6 years. And I'm hoping that we change both the trajectory of the debt and the ability of market makers to make markets. And also remember, there are a lot of people, going down to Washington who actually like bad markets. And the problem with the bad markets isn't that it's bad for the big banks who make markets. It's bad for the people who raise money, small businesses, asset-backed securities, middle market companies, corporations, the United States government. And that volatility scares people. And then also it happened, markets closed. And you saw that happen multiple times in the last 12 years where you couldn't sell a high yield bond. If you're going to sell a lot of treasuries, you could have had a little bit of issue. So yeah, it's coming. It's just part of all the stuff we talked about. And unfortunately, it may be that we need that to wake us up. It's an unfortunate thing. So.
Jamie Dimon talks about cracks happening in the U.S. debt market. And what he means by that is that the U.S. Treasury is going to issue so much debt that there is not enough buyers, and it causes the price of U.S. Treasuries to decline rapidly, which would make the yields increase rapidly. This would be devastating to the real economy as well as the financial economy, and it would ripple throughout the world. To keep this into perspective, the interest rates are higher than they were in 2008. In the past, I've talked about stablecoin providers buying U.S. debt to back stablecoins. And the stablecoin bill certainly helps in that regard. But the question is, will it be enough? Will there be enough buyers of U.S. debt to a point where the Federal Reserve doesn't have to step in? You see, the danger is when the Fed steps in and starts to manipulate the yield curve, they start buying longer term debt, their balance sheet explodes, and that's where hyperinflation takes place. Stablecoin providers would more likely be mandated to buy short duration bonds rather than long term bonds like 10 and 30-year bonds. They're looking for cash and cash equivalent, not 30-year obligations or 10-year obligations.
And the preeminent economy, in 40 years, we will not be the reserve currency. That's a fact. Just read history. Now I think we will be. Warren Buffett here would tell you we're enormously resilient. I agree with that. I think this time is different. This time we have to get our act together, and we have to do it very quickly.
That was a big answer. There's a lot to dig into there. So the takeaway is geopolitics.
I have a great quote for the first thing, too. Someone said, the government spends like a drunken sailor, and someone else said, no, a drunken sailor spends his own money.
We are likely to have a completely different system in 40 years, a system that we can't even comprehend yet. But keep in mind, it is a ratio of debt to GDP. So the more GDP that we add to our economy, the more likely it is that our currency will stabilize and keep its purchasing power. And there is amazing advancements happening in technology. Bringing industry and manufacturing back to the United States is not wrong in this aspect. If the Fed tried to control the bond market and caused hyperinflation, this would be very beneficial to the crypto markets. This could certainly be a catalyst to reset our system into a new system that involves blockchain and crypto assets.
The tectonic plates are shifting. We got to get our heads wrapped around that. Those tectonic plates are the geopolitics with these terrible wars, terrible proxy terrorist activity around the world, North Korea, the potential proliferation of nuclear weapons over time, which is the greatest threat to mankind. And then you have the other tectonic shift is the global economy. So the global military umbrella of America, and then the global economy, of which trade is a part. The other parts are do people want to partner with you? Do you have your alliances? Do you have investment agreements? And all those various things, and they're changing. And then our debt, which you just heard a bunch of folks talk about eloquently, it's large, and it's not just us. We added $10 trillion in 5 years. We have, you had Reagan up there talking about deficits. The debt to GDP was 35%, and the deficit was 3.5%. Today, it's 100% debt to GDP net, and a deficit of almost 7%, highest peacetime ever. And when the CBO does their numbers, which I don't really trust, by the way, they should do the stress test. Like, what happens if we go into a recession? That 7% will be 10%. And so we have problems, and we got to deal with them. And then the biggest one, underlying both that, is the enemy within.
The big banks are mandated by the U.S. government to hold a large amount of U.S. treasuries. These are collateral requirements. But the big banks are consistently doing stress tests, while the Federal Reserve and other regulators are doing them infrequently. The big banks are doing them frequently. So under these scenarios, what we're talking about is very sophisticated AI as well as traders shorting treasuries at the same time that they're holding them in order to manage their portfolio with as least amount of risk as possible. Now, when they're shorting treasuries, this is more sell pressure into the U.S. Treasury market that Jamie Dimon has said that there's already cracks happening in this bond market.
I wouldn't rethink it. We know what constitutes national security. We need, I was saying we shouldn't be stockpiling Bitcoin. We should be stockpiling guns, bullets, tanks, planes, drones, rare earths. We know what we need to do. This is not a mystery.
Did you say stockpiling Bitcoin?
I said we shouldn't be stockpiling Bitcoin.
Oh, it shouldn't be. Okay.
We should be stockpiling bullets.
Okay.
The military guys tell you that, if there's a war in the South China Sea, we have missiles for 7 days. Okay, come on. I mean, we can't say that with a straight face and think that's okay. So we know what to do. We just got to now go about doing it.
How often do we hear a CEO of a large bank tell us that we should be stockpiling bullets rather than stockpiling Bitcoin? JP Morgan is one of the largest banks in the world, and Jamie Dimon reveals that he just left China.
I just got back from China last week. They're not scared, folks. This notion they're going to come bow to America, I wouldn't count on that. And when they have a problem, they put 100,000 engineers on it. And
to me, this is very unusual for the CEO of a large bank to caution the public that he's very scared after he left China, that we should be stockpiling bullets, and also that the entire U.S. system is looking like it could collapse. The U.S. debt market is the entire U.S. system. The bond market is considered to be the smartest market, meaning that the smart money rules the bond market, and they're able to sniff out problems before the stock market or any other market is able to see them. The big banks cause these problems in the first place. They set off this chain reaction, and I certainly do not want to become or sound like a sympathizer towards the big banks, but there are very valid points that Jamie Dimon is making about the entire situation. They're going to make money off of the catastrophe. They see the catastrophe. They're prepared for it while the regulators are not. And they most likely will benefit from whatever happens. And he's giving an honest, frank warning, not only about the bond market, but about China and about the fact that we should be arming ourselves. The warning about China is not just coming from Jamie Dimon. You have U.S. generals sounding the alarm about China. There is a real concern for war happening in the near term. And if you study wars, you'll see that there is a pattern of economic despair. There's a pattern of trade wars, of sanctions, of all of the things that we're seeing.
So the military can't have a 30-year program. They've got to be able to cancel that drone program, build up that drone program, hire this person to do the software. We have to allow them to do multi-year budgeting. We essentially don't. The military tells me it costs them $50 billion a year, and we have to spend more.
With everything that Jamie Dimon has warned us about, his solution to the problem is actually to add more debt and create more pressure within the bond market. And you can argue that Jamie Dimon has been close to every president. Every single time there's an economic crisis, the president calls Jamie Dimon and asks for advice. He has also given the Senate and Congress advice as well in front of congressional hearings and Senate banking committees. U.S. lawmakers have leaned on JP Morgan and Jamie Dimon, and you can argue that where we are today is a direct result of the advice he has given.
And also remember, there are a lot of people, going down to Washington who actually like bad markets. And the problem with the bad markets isn't that it's bad for the big banks who make markets. It's bad for the people who raise money, small businesses, asset-backed securities, middle market companies, corporations, the United States government. And that volatility scares people.
There are large companies, there are large entities out there that lobby the government for things that are not in the people's best interest, but for that entity's best interest. And this includes things like war, recessions, or poisoning our food. The list goes on and on of the harmful things that companies would advocate for. The Trump administration received money from the crypto industry in order for him to raise money for his campaign. I ask myself, is the crypto industry a destructive industry like the war machine? You see, it's beneficial for debts and deficits to be added to the balance sheet of the government. It's beneficial for the U.S. dollar to be dethroned as the reserve currency. To achieve victory, we must amass our forces at the hub of all power and movement, the enemy's center of gravity. Thanks, everyone. I hope you enjoyed the show. Please take a moment to like and subscribe. If you enjoy content like this, please consider joining my Patreon. weekly chats, ad-free videos, research, and much, much more.